Let me tell you about two hypothetical investors named Jake and David. Our first subject made his first million before he was 30, whereas the second couldn't even tell you what his portfolio was worth. Over the course of the 20 years, one lost 70% of their wealth and the other retired early. Stick around to see which one came out on top. Jake is 25 and works in sales. He's the loudest guy in the room talking about his latest trade. He knows the tickers, the charts, and every position he's holding. He genuinely believes he can crack the market and wants to go big in life. David, on the other hand, is 28 and works in accounting. At a party, you probably wouldn't even remember him. When finances come up, he keeps his opinion to himself, lives a modest lifestyle, and drives a vintage 20-year-old truck he fixes himself. Let's say both hypothetically start with $10,000 to invest toward retirement. Jake hits the ground running. He's picking stocks, sizing positions from day one. He's actively trading. David, on the other hand, opens a brokerage account, puts his money into an S&P 500 index fund, sets up automatic contributions, and closes the app. In the first couple of years, Jake is significantly up. He makes some killer trades that pay off big and is getting higher annual returns than most. David, on the other hand, hasn't even looked at his account. He spends most of his time with his family, doing the things he enjoys and not worrying about his finances. After 10 years, Jake is crushing the market and getting huge returns, but he's glued to his phone and has to watch the market constantly. This allows him to buy his dream car, go on lavish vacations, and live life to the max. However, one morning, it all changes. He begins his day optimistic and makes several trades that look great. But by 10 a.m., something's wrong. An unexpected Fed announcement moves the market in a direction nobody saw coming. And the sectors he's concentrated in are selling off hard. And he's way over leveraged. The market drops 10% and his losses are getting amplified. By market close, the damage is done, and Jake has lost 70% of his entire portfolio, a sum of about $1.5 million. The worst part is that Jake didn't even do anything technically wrong. He made the same trades he's made 100 times before. This time he used leverage and found himself on the wrong side of the market. Meanwhile, David still hasn't looked at his portfolio, not even sure of his net worth, and still just enjoying his life. 20 years have passed and Jake is 45 and still working to rebuild what he lost. His net worth is about $500,000, a fraction of what he once had, and unfortunately for him, he can't stop trading or retire. David is 48. He still hardly looks at his account, has never traded a single stock. He plans to retire this year. He sits down to review his portfolio, which has now grown to $3 million from the compounding interest and 20 years of consistent returns. David's secret was simple. He never tried to beat the market by trading and just let the market do what it does. I know Jake because I was him for most of my career. I made my first $500,000 while I was still in college, and I also lost everything twice. I was able to rebuild both times, but it was painful. And what I learned from all of that is the same lesson David figured out at 28, without any of the pain. The market is always winning. It's the most efficient pricing machine ever built. It has millions of investors, billions of data points, and is processing complex information all the time. Whatever edge you think you found to beat it, it will close before you can blink. It's a reason to stop fighting the market and start owning it. Owning the market might not be sexy or popular, but David's $3 million says it doesn't have to be. I hope this helps you think more about your investing approach. Let me know if you identified more with Jake or David. To hear more stories like this and learn more about investing strategies, hit subscribe.